Hi, good morning, everybody. Jeff Fitzpatrick on this Monday, the 17th of June, 2024. And it's my weekly quick look at what's going on in the stocks and options world that I inhabit. And in this edition, I'm going to be looking at Beta, and I think it's an underrated facility that we have. So let's get cracking. I haven't actually updated this week, and to be fair with you, I don't really actually intend to. I'm going to drop this from the weekly video. The point is that the figures are just not changing that much. Basically, I'm telling you every week that TICN has improved by 140% since the 31st of March 2020, and the others about 100, about 120, and about 70, 80 to 100%. The figures are not changing, and I don't really expect them to change that much. So unless I see something radically different in these figures, I will be reporting them in future. The other thing about it is that I no longer use the TICN list. The TICN list on the website comprises stocks that have been 4x4 scorers using the TICN scoring system since way back. So up and coming new stocks don't get included. And some of the stocks in the list may well have been 4x4s a long time ago, but it may also be a long time since they were. So I'm now using a fresh filtered list every week, pulling that list from Value Line. And also, I'm also going to drop this news item unless there is something really specific I see coming, like interest rate changes or a major piece of information concerning a stock that we're specifically dealing with at the present. I'm going to pull it because I don't think people are getting that much benefit from it. However, I'm going to spend time on the short watch list generation, which, as you should know by now, I start with the long list, which is reducing 7,000 stocks covered by Value Line to about 150. This week is 157. And I then use the charts and indicators to eliminate at least 100 stocks. And then I use analysis of the 15 Value Line parameters that I look at specifically to get it down to 5, 10 stocks, something like that. And then I use the trading platform to look at potential trades, to get the buying power, the premiums available, and the returns on capital, etc. That gets me down to a short list of 3 or 4 stocks. So on my initial list this week, there were 13 stocks that I took out. That's because they no longer match the absolute basic criteria. They don't have a timeliness score of 1, 2, or 3, or a safety score of 1, 2, or 3, or they're not at least B plus for their financial standing. So 13 came out and 12 came in. It is a very dynamic list. And of the stocks that newly came in, only one of them, FHN, got to the next stage. So once I looked at the charts for them and the indicators, most of them fell away. One got through to that level, which was FHN, and then that failed at the next hurdle. So there's very few. It's very, very tight system, this. Difficult to get on the list. So let's look at Beta. And to do this, I'm going to go to the live Stockpilot dashboard. And here we are. So the stock that I've currently got on the drop-down list is CMCSA. And I've started with this one because the beta is particularly interesting. But let's have a little look around it first of all. So we get the name, and it's Comcast Corporation. And we also get the industry. Now, this is really the industry as far as the broader stock market is concerned. I've now found a way of changing this. I will be changing it to put a more descriptive industry in it. So at the moment it says telecommunication services, but in actual fact, these people are broadcasters. They're a bit like Sky. We've got the last Value Line report date, so it's pretty fresh, 7th of June. And it's got a timeless score of 3 and safety score of 1. The last 4 quarters calculating the price to earnings ratio on that, it's nice and low at 9.15, and the price to book multiple is 1.68. So that's we're going to get a significant share of this company if we put some stock into it. Currently, it's trading at 37.44. That'll be a live price. That'll be the closing price on Friday. And we've got earnings coming up at the end of July, so no need to worry about that for the moment. This company hasn't had any losses in any quarter in the last 3 years. And the dividend paid last year was $1.14 is what it is, basically, which is not a bad percentage on that price. And the total return over the last 5 years is minus 1.9%. That's telling me that they've had some trouble in the past. That can be quite good. Some of the best stocks that we will find are stocks that have taken a tumble, sorted themselves out, and are rising again. Constantly good doesn't do as much good. So last year's earnings per share was $4. Again, not bad. And the percentage of earnings paid as dividend was nearly 30%. That's quite high, but I don't mind taking dividends. The earnings predictability is 95 out of 100. Based on the last 8 years, that's pretty good. So going to the next level here, what have we got? The headroom, that's the space up to the top of the 52-week high. It's got 21%. That's all right. I can cope with 21%. Ideally, it would be 33%, but that's all right. Headroom to the middle forecast is 17.52. However, I haven't really got a lot of time for the forecast, so not going to do much good, that one. The foot room, how much space is below this to the bottom of the 52-week low range? And that's 9%, so it's fairly near the bottom anyway, so not a problem. A little bit more debt than we would want. Instead of being 50% or less, it's 64%. And the asset cover is also a little bit low here at 59%. So it might not be an ideal choice. There's very few of these are perfect. But let's have a look at this. So the beta is 0.85. Using the traditional TICN rating, that would put it in the red flag area, which is down there. But what I want to show you is this. If we look at the increase that is forecast, we've got nearly half of it coming from performance, the other half coming from just the general increase in the market, and that moves around a lot depending on the beta. I'll show you another example in a moment, but just continuing across, the normal 18-month forecast value line mid is here. It's the mid is 44, and above that you've got 56 and 33. So a range of $23. That's huge on a stock that's only $37 now, and that's because of the very high earnings predictability that you've got there. It does seem, but it should be less than that, is what I think. If you can predict the earnings to a 95% accuracy, and you know what the price to earnings ratio is, then you really don't need such a wide range within these forecasts. Looking at that statistically, so based on the forecast of the next 2 years of earnings, which should be about 95% correct, looking at that and the price to earnings ratio, then I see the stock getting to more like 41 versus the 44, so a bit lower. And the range is actually coming out even higher based on the PE ratio. I've also put in here a new forecast, which is simply saying, hey, look, where are we now? If the thing just goes up with the market, like 10% per annum, where's it get to? And depending on its performance, if it's got a timeliness score of 1, I'll give it an extra 10%. If it's 2, I'll give it 5%. If it's 3, I'll say, no, you're only going to get the market increase. And also, if it's got a timeless score of 4, then I'm going to take 5% off. And if it's got 5, I'm going to take 10% off. So that's where I'm getting some forecast information, which has got a long way to go yet. I'm sort of building up data on that. This entered the shortlist on the 28th of May. At that point, it was 37.54. It's gone down a little bit in 20 days out of the 18 months, 548 days remaining. And the original value line forecast going back 18 months ago was $45. So that one is not very good. So that's one of them. Let me show you another example, which is HURN, H-U-R-N. Okay. Specifically, looking at the beta, it's lower here, but we've got a performance forecast increase, which is only 18% of the total. Most of the increase that is forecast on this stock is just coming from the general market 10% per annum increase. So we're relying less on the company being able to do the business here. Current price is 94. Even just going with the market, it should get to 120. The value line is saying 126 as their midpoint. And statistically, using again the forecast earnings and the price to earnings ratio, it would be 132. Now, this has got an earnings predictability of 75, so it gets a wider range. And it's getting 5% because of its score on timeliness of 2. So that's how I'm looking at things. So let's see what the outcome of all this is for this week. And here we have it. So there are no new stocks in here compared to last week. There are changes to it. Some of the months I'm using have changed. The number of days left to expiration has obviously changed. Some of the strike prices have changed, and some of the open interest levels have changed. And obviously, by those changes, some of the calculations have also changed. What I noticed was very few of the stock buying power levels change. And where they did change, they were changing not by a lot, and they were going down, which is good for us. So top of the shop this week, we got PRGO, BMY, and AKAM, and CVS, and HURN. Then we started to get a bit low on the annualized return, coming down to MGPI at the bottom. It's only 8% return, 32% annualized. So by that point, I'm sort of losing interest like crazy. So top of my hit parade, really the top 4 or 5 on here. And even then, it's a question of waiting to actually get them at the right moment. So this is, I'm saying here, these stocks are good quality stocks. The parameters look right. They are in approximately the right place on timing and charts, but we've got an expiration week here, and things are coming down. So we need just to be a little bit patient and catch the wave at the right time. Let's have a look at 1 or 2 of them to see what that means. Okay, so here we have PRGO, and we can see the latest forecast, mid-forecast from value line, that is 31. And we're currently at sort of 26.85. So not a huge increase, but we don't therefore have to give it that long to get there. So there's a benefit in that. And that's probably why the annualized return on capital is so good. But looking at the actual chart, first of all, we're still going down. So we had a reverse J last week. It's a little bit of upset there. I want to see that sort of get to the bottom and turn around again, much like it did here and as it did here. So that's Prego. So it's near, but not quite. And the indicators need to now again switch around a bit as they were last week back up there. Another one is BMY. A very similar story. We've had a reverse J, we've had a couple, but we are beginning to trend up. We're not asking you to do a huge amount of work, and I'm not going for strike prices which match those 80-month forecasts. I'm going what I think is far more logical, where there have been previous highs and lows, so this sort of level or even this sort of level. And ACAM was another one. There it is, looking a bit more like the indicators are very much almost there. We have got a positive candle. We've got a lovely gap to help us find a decent strike price in. So, that one is nearer than the others. But again, I might leave it until after we get through Expiration Friday. Okay, so if you're watching this and you're not currently a member of one of our investment clubs, go along to myinvestmentclub.co.uk. You can find out a lot more about what we do there. You're also welcome to attend our meetings. We have meetings on Tuesday, Wednesday, and Thursday of this week. You're welcome to sit in and observe, no problem. Just get in touch. And it'd be good to see you come on board. So next week, I'm not even sure I'll be able to get a video out next week. The coming weekend, Friday, Saturday, Sunday, I'll be at the Sofitel Terminal 5 in Heathrow running training. Friday night is simply about live trading. Saturday is a scoring system. Sunday, I go into the research and also into options trading. The Sunday in particular, I have a huge amount to unveil there. A little bit of a taster of it was the beta stuff today, but I've got a lot more than that and a really exciting new trade that is being fantastic for helping with stocks that we're into at prices that we don't like. So if you can make it to that, come along and join us. Again, myinvestmentclub.co.uk is where you can book. We've got a smaller room and limited seating this time, so if you want to come and join us, you need to get on with it. And again, just to push the book, if you haven't read it yet, it's available on Amazon and many other platforms and Audible. It's a good listen, I think. I'm being told anyway. And that's about it for this week. So thank you, and hopefully I'll see you at the Sofitel in London, if not in my next video. Thanks again for listening.